All right, everybody, welcome back. Got a lot to get into today. It's been an interesting setup. For those of you watching, we changed the camera angles a little bit. I am now standing as opposed to sitting. I like this a whole lot more. We also updated the audio so that we're sounding a little bit more traditionally like we sounded. A lot of you who listened on the previous podcast told us that we sound a little tinny. This should hopefully revert us back to previous settings or close to it. Let's talk about how to make some money. In this particular market, there's going to be two resounding themes, and I want to make sure we talk about all the topics we're going to cover today right off the top. Number one, hedge fund investing and analytics made simple. Number two, the policy rhetoric game. Number three, the housing market. We are going to cap it all off with a little bit of Saks Fifth Avenue and the downfall there and what you should expect as a consumer. But before we get into all that, this show is brought to you by Fridays. If you're interested in health, wellness, GLP-1s, testosterone, even some peptides, you want to call or reach out to Fridays. Go to joinfridays.com, enter in code HIGHER. You'll get a discount. You'll help us. We'll help you. It's an amazing full circle moment. Thank you, everybody, for doing that. Let's get into some of the models that we're talking about here. Hedge fund modeling made simple. For those of you who have been watching us on the podcast or watching us in real time here on the show, you know that we've been talking about this for a long time, and I'm really excited to bring you some of these models. This being the first one, this is the U.S. market risk profile. It is proprietary. Nobody else has this. This is just us, okay? So why this is important is something that you need to be understanding of. It's supposed to give you a snapshot of the market right away. But what I wanted to do is explain it a little bit more in detail. I've done some previous shows, but I think continuing to talk about it has value here. So number one, market status bar right there. It tells you whether the market's open, whether it's pre-market, market open, post-market, or closed market. You need to know that because this snapshot at any point in time is going to tell you at the time of day what's going on. These are not using the actual indices, and I'm going to explain why so you have a better understanding of why this matters to you when looking at charts like this or just looking at the indexes in general, right? This is not showing you whether the stocks are red or green. That's just anecdotal. What it's really pointing out is whether we are in a tech-led narrow rally like we are today, or we're more in a mixed strategy, or we're in a broad rally. So if you look at the chart here and you look right there, that it means we are in effectively a narrow rally, and it's a narrow rally led by tech, which should not be a surprise given what's happened with the Mag 7 and the S&P 500. What this chart does is it attempts to look at things like the Dow Jones Industrial Average, the S&P 500, the Nasdaq Composite, the Russell 2000, and Invesco QQQ, all of which have heavier weightings to certain sectors and spaces. Like, for example, we know the Nasdaq is heavy on tech. We know the QQQ is a top 100 in this tech space. So those have all been risk weighted with a proprietary risk model to give us, vis-a-vis these ETFs, a better look on the market and what's happening. This is not opinion, so you don't have to worry about a talking head on the news telling you what the market's doing. We'll tell you right here with a consistent analytical approach. This is just straight based on the numbers. This is real money positioning because we're using the ETFs and not the indices. The other chart that I'm happy to bring you, this is the first one. This is the first time we're showing this. This is something we are calling the synthetic volatility index. Right now, it's saying that the market is in fact calm and that we have an 84 number. You'll look here, that is close to the top of where you want to be. This is going to be our substitute for the VIX. The VIX will normally give you a number that says something like 18. And you have to interpret what that means. I didn't want that to be the case for our listeners of the show. Anybody who listens in real time, I wanted them to see exactly what's happening in the market at all times so they can literally look at this and get a quick snapshot and move on for the day. But what we did to this, we built this out in a very, very challenging algorithmic way so that we have a scale from 0 to 100, which everybody can relate to because we all had math and we all had tests back in the day. Let me move this over there a little bit so I can get a better view. Perfect. We all went through this in school. We know that 80 is a B, 90 is an A, and so on and so forth. And this puts the market in the same perspective. I did apply a heat map down here, which gives you green good, red bad. Very simple stuff. But this tells you at any point in time the risk and the fear. This is our fear gauge. This is the higher standard variant of this. And what this is supposed to really do is give you a single abstract number, in this case 84, which breaks down volatility into real world forces. And I'm going to explain those a little bit here. And I wrote this down because I don't want to screw it up. How violent prices are moving, right? That's volatility. How violently they're moving throughout the day. How chaotic intraday trading has become, right? Intraday range stress right there. And how risky overnight gaps are. That's the gap analysis there. And how dislocated different parts of the market are from each other. That's the cross-market volatility. And those four factors come in a proprietary method to give you your total synthetic volatility score down there at the bottom, which we show at the top with a color code. So at any point in time, you'll know both this chart here, the risk profile of the market, it's calm, and this one here telling you what type of market we're in. We're in a calm, tech-led rally. And this chart, combined with others that we're going to roll out over time, are going to give you a look at what hedge funds do. Is they take this type of modeling and analytics, real-time data like we have in the stock ticker down below, like we have in the stock charts that we have, and it allows them to look at the market from a proprietary way and figure out what they're going to do with their investments. We're not here to give you investment advice, but I am here to let you know the status of the market so that you can make more informed decisions as a result of that. So what this is supposed to do is give you that composite look at the end of the day. We're going to be rolling out a macro calendar, a macro events calendar to show you exactly what's happening in the economy in the future so you know exactly where things are going to happen and when. We're going to give you some estimations as to what we think things like inflation and PPI numbers that are coming out are going to say before they come out. And then we're also going to rehash that after they come out to see where and if we went wrong. And then we're going to take a look at things like Fed liquidity in the system in a very similar way. I'm just trying to figure out exactly how to present it to you guys right now, because one of the challenges that we have is I want to make things very simple. I want to make things super easy to read, and I want to give everybody the weaponized information that they can use to then, in turn, be better strategic investors over time. So thank you for those of you who have helped me out in putting together some of the algorithms and the modeling. It's been very, very important to me to get everybody's input and to try to weigh into it. My wife is in the comments. Hey, boo, hey. There you are. I see you, girl. What's up? Let's clear that out real quick. All right. So let's go into the stock market and some of the stuff that we're seeing today. This is going to be a large part of the segment that we're going to spend time on. I think this is important. This is going to be a narrative that we're seeing consistently over the course of the next several weeks and months. And this is because you need to frame this all right. there is the midterm elections coming up, and the Republicans need to ensure, and they have a fiduciary responsibility to their parties to ensure that they have power. And that sounds terrible, I know, but I'm not saying that in like a I want to dominate people power kind of way. I'm saying that in they have their party in power in the Senate and in the House and in the White House. And they want to do their best to try to stay in those positions and continue to influence policy. Now, that in and of itself is an earnest enough effort, I would suppose, but you need to understand that a lot of the things that you're hearing right now in the news are throwing things up to the populace opinion and seeing if it sticks. So we heard, for example, the first obvious example of this was the 50-year mortgage, right? We heard, oh, we're going to roll out a 50-year mortgage. And then you went straight to X and other social platforms, which we're going to spend some time on later on in the show. And you saw just this unilateral disdain for it. People were not happy with the idea of a 50-year mortgage because they understood the math. Compound interest makes this way, 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 way more expensive than a 30-year mortgage does. Matter of fact, it doubles, effectively, more than doubles the interest that you would pay over the life of the loan. And of course, it means that you wouldn't effectively own a home for 50 years, which in and of itself is problematic. So I think you're going to see a lot of this throw up policy commentary and see what sticks. You saw that with the 50-year mortgage. You saw that with the banning institutional investors from buying real estate. You saw that with some of the credit card interest rate caps. These are really playing to the populist sentiment. And whether those actually become law or something actually happens there, that remains to be seen. I don't know that you're going to see it quite that fast, but the stock market seems to continue to shrug Trump and some of this political stuff. I think there's some important stuff to talk about here. So let's go to one of my favorite new functions we have here, and that is the quote chart. Let's jump into this. Economists reiterate Powell's framing that the investigation... Oh, I'm sorry. Am I on the right one here? No, I'm not. There you go. There you go. So economists reiterate Powell's framing that the investigation was less about the central bank's renovation and more about interest rates not coming down as far as Wall Street hopes. Former Fed Chair Janet Yellen said she was, quote, surprised the market is not more concerned. And I think that's going to be a recurring theme here as we go through what the market is saying to us, because guess what? The market is surprised that we're not seeing the level of concern in some of the things that are happening. And the reason is because I think everybody understands this is some policy positioning, right? This is some of the market saying, okay, you know what? I don't necessarily believe it. And let's see what the market's doing. The S&P 500 made up ground and closed at all-time highs on Monday, despite the criminal investigation into Fed's Jerome Powell. You follow the channel, you saw us talk about his commentary on Sunday on the last live that we did. Let's see here. I'm going to scroll down a little bit, take a look at some of the comments. I know there's some people in the chats there. What up, Sean? Who's not concerned? Everybody seems to be not concerned. That's the problem. Conventional market wisdom suggests that political turmoil can drive down stock markets in near term as traders hedge bets, but we're not seeing that. Matter of fact, you saw the S&P coming close to those all-time highs. Traders appear to be trying to decide whether this is a short-term flare-up versus long-term problem, and I think that's going to be a consistent theme as we go through some of the things that we're seeing here. So a major development in Trump's feud is set to happen this week in the Supreme Court. And for those of you who have not been watching, this does impact your wallet. So you do need to be aware. A court case next week will likely to be the next big development for the central bank in its quest to maintain political independence. The Supreme Court will hear arguments on January 21st related to President Donald Trump's efforts to fire Federal Reserve Governor Lisa Cook. Now, that in and of itself might be something that everybody has forgotten about, but didn't go away. He tried to suggest, the president and the White House, I probably should not make it personalized, but the White House tried to suggest that Lisa Cook, as a Fed governor, had lied on mortgage applications to get lower interest rates in what was an owner-occupied versus non-owner-occupied property. Now, I don't think lying is ever good. I think the stigma there is real, particularly if you're in a policy position, and you should always be telling the truth, especially in that position. That being said, do I think this is enough to remove a Fed governor without meaningful evidence, one way or the other? I don't know. And that's where you're going to get the Supreme Court ruling on this commentary, but that will inch Trump closer to being able to control things. If he were to win this, let's just say in a hypothetical, and you were to have Myron in, who's voting his way right now, and currently a dissenting vote on the FOMC in the panel here, but then you get Jerome Powell forced out and Lisa Cook forced out. That's two, including Jerome Powell, including Myron, that you now have a bigger consensus of people who are presumptively going to vote your way. This in the face of the fact that JP Morgan Chase's analysts have come out saying they don't expect any more rate cuts. They expect actually a rate hike in 2027, which I thought was a fascinating position to take right now, given all of this that likely is going to happen. So I think that should the White House win the case, it could set an important precedent for the president's ongoing quest against the Fed, Jerome Powell. So Lisa Cook is a segue to that. The efforts to remove both officials provide further incentive for Powell to serve out his term on the board as bulwark against Trump's efforts to thwart SAT vocabulary. Okay, I think this is probably interesting and worthwhile to note. Let's jump on over to the quotes again because I want to read you one I thought was really important. Let's go down here. I've got a lot of stuff going on in the background these days, so it's been hard to keep up. While this was never a base case, and indeed it seemed like a relatively remote possibility, this weekend's events likely increased the probability that Powell could choose to remain at the Fed. And I think that's an interesting comment. So essentially, what's happening here is the market is saying, hey, Jerome Powell was going to be out as the chair of the FOMC in May. That was the end of his term. But he was not off the FOMC's voting panel, so he could and likely would continue to have influence in how they voted and making sure that they voted in line with his policy. Well, if that were to happen, I think that would be very different results for the economy and all of us financially. But now you've got Jerome Powell coming out using the Fed's channels as an output to make a public statement on Sunday. And as a result of that, it's pretty clear that he's going to push back and be relatively defiant in how he handles things in the future. And I think that's largely what the market's signaling here, saying, hey, I don't think he's going to go anywhere. And even if he does go anywhere, I don't think that his going anywhere is going to be a significant focus for the economy in the way it's responding. And then guess what? He's not going to leave the FOMC, so he's still going to have input there. Let me check some of the comments real quick. S&P, Treasury, FOMC are all divestments in separate derivatives within ETFs. Yes. And I will break that down on a future explanation of the proprietary models that we've built here. I appreciate the commentary, and this is absolutely accurate. I think we're gonna talk a little bit about why our modeling chose ETFs as opposed to some of the other paths and why we've accounted for this. Again, I want to do so in a narrowly tailored fashion, not to be cryptic or skirt the commentary, but just because a lot of what we built is proprietary and took a lot of time to kind of figure out the mathematics. But we will get to that, and I think we've got a good answer for you on that one. But we beta tested the hell out of it, and we know it works. So, but more on that coming. And what I'm going to probably do for that, just so you know, is I'm going to put together some type of one pager, which explains enough to where you get the insight as to why this works and what we thought about and thought through. And then we'll do that for each one of the models and then post that to our forthcoming website redesign. Again, I'm trying to roll it out and kind of beta test and see where the breaking points are before we go too far down that path. Let's go into another quote here. Indeed, if the administration insists on following through with a criminal prosecution of Jerome Powell and Senate Republicans stand firm, it's not advancing nominees to the Federal Reserve Board. It's likely the FOMC would choose Powell to remain as chair. So that's actually an interesting statement that I thought came from this article here, where I thought was really powerful, right? If we're going to get into a fight about removing Jerome Powell, that could be interesting in that there's going to be halts and stays on actions that are taken. So the White House could not push him out at any point in time. But it's not just the U.S. that's responding to this. It's global central bankers as well. We have this article coming up here. Let me pull this bad boy up if I can. There we go. Perfect. All right. This global central bankers unite in defense of Fed Jerome Powell. And there's a lot of defense. Global central bankers issued a statement Tuesday defending the Fed Chair Jerome Powell following the launch of a criminal investigation into the central bank chief. Quote, "We stand in full solidarity." Full solidarity. So they're coming out swinging here. Let's go to the quote cards because your boy came prepared today every once in a while. And don't look this off. I'm going to get to some of the meat and potatoes here. I'm just setting you up for what I think is a real funny part of this. We stand in full solidarity with Federal Reserve and its chair, Jerome H. Powell, European Central Bank President and Bank of England Governor, all came together to say these things. I think that's pretty worthwhile to note. What's really fascinating is that, okay, so now you got the public sentiment who's looking at this Lisa Cook case. you've also got everybody coming out in pretty vocal and open support of Jerome Powell. And you're going to see yourself in a situation that this plays out over time, but the market should be reactive, and it's not. And that's exactly what we're seeing here, is that the market is just saying we're going to wait and see. Maybe it's I don't know, too much dopamine. Maybe it's they're just overstimulated. Maybe it's because we're close to all-time highs in the markets, but they don't seem to really care, and they're going to wait and play out until you get something more definitive. Certainly, if the Supreme Court rules in Lisa Cook one way or the other, it's going to move the markets, and I think you can anticipate that. But what's been really fascinating to watch is the narrative between Jerome Powell, Jamie Dimon and Donald Trump, which picked up yesterday. I did not expect that to happen. But before I go on, I think there's another quote here I want to read. I want to make sure I get the full quote here. The independence of central banks is a cornerstone of price, financial, and economic stability in the interest of citizens that we serve. It is therefore critical to preserve that independence with full respect for the role and rule of law and democracy accountability, they added. Powell has served with integrity, focused on his mandate, and unwavering commitment to the public interest, the statement said. To us, he is a respected colleague who is held in the highest regard by all who have worked with him. That's international central banks presidents. So that's meaningful, right? You got people who've worked with you consistently throughout the years coming out to vocally support you. And then we had some pretty interesting things happen yesterday, which I got to tell you, I think are hilarious. Okay. So let's get into the first here. And I'm going to bring up the Fox News article, but I have quotes for this already prepared in advance. Jamie Dimon warns Federal Reserve subpoena, not a good idea. JP Morgan CEO says Justice Department action against Powell risk undermining central banks. So here's a timeline of what happened, and I think this is great. Let me go to the comments real quick. Perfect. All right, great. And what happened is Jamie Dimon decided that he was going to respond publicly. And Jamie Dimon is very calculated. He is, in a lot of ways, a politician as much as he is a banker, and I have a ton of respect for him. While I don't agree with everything that the Fed has done, I do have enormous respect for Jay Powell, the man, Jamie Dimon. Of course, he continued from there and went on and said, everyone we know believes in Fed independence. Anything that chips away at that is probably not a good idea, in my view. It will have the reverse consequences. It will probably raise inflation expectations. I think that's right. I think when you look at the market, and this is part of the reason why we did things like this here, the synthetic volatility index. Oops, it covered my face. Look at that. Let's try that again. What's going on over here? Let's go back to the status chart there, and let's go back to synthetic volatility index. Perfect. Okay. So with the synthetic volatility index, yeah, I mean, I think it's right. Is you do have a possibility to introduce volatility to the market, and this is not showing that now. So clearly the market isn't really freaking out about all this back and forth and rhetoric. And again, if you listen to what I said at the start off the top of the show, you do have a pretty reasonable assessment of the market and people saying, you know what, I'm going to wait and see how this plays out. This is policy rhetoric. We're throwing on the wall to see what sticks. And when people like Jamie Dimon respond to it, it feeds into this parasitic narrative. We all need to be aware of this because it happens all the time. If the White House or anybody in politics says something ahead of midterm elections, and that is a very stigmatized comment, they're, in some cases, trying to see how you, the people, respond to it. And if we respond by going back and forth on social platforms and making this narrative important, and the mainstream media picks it up, and people like Jamie Dimon opine on it, you get this feedback loop of people responding to Jamie Dimon's comments, just like I'm doing, and we listen to this back and forth, and this stigma, this drama-driven, voyeuristic side of us as humans feed into it, but it allows the person who made the initial comment to see, am I likely going to curry more or less political favor by doing this, by going to the narrative on social media, and they can just quietly observe how this plays out. Again, a great example of this is that 50-year mortgage, right? This has been something that was talked about prior to the White House's statements to this effect for probably the greater portion of 4 or 5 years now. And when they made all these comments, they were people who, pundits of it, were trying to find a solution to the affordability crisis. And a lot of people are point blank just say, hey, look, you just need more properties. It's a supply demand issue. Whatever side of the aisle you're on, I think it's more complicated than that. I don't think that lower rates are going to solve this problem. I think there's a lot of people who make a lot of money during lower rates. I own real estate. I like lower rates because it typically brings property values up as well. But that being said, I don't know if that's the solution to the problem here. I don't think anyone's ever proposed a solution to me, at least, that looks like this is a really good, like, easy fix here. But my stance on it might be a little bit different than most. So again, that was put out there. The White House put it out after seeing it online, people making comments to that effect. And guess what? The response was overwhelmingly negative. So you know what? Probably not going to run that down as a politician. So what do? You go to the next thing. You say, okay, well, institutional buyers, big spin on social media and the narrative. A lot of people think that institutional buyers are a problem here. Even if they're not a problem, I can get a dual win as a politician. Number one, I can spin the narrative that I stopped this. Number two, institutional buyers aren't really materially impacted because they'll be able to buy because institutions got weird labels and we can always carve them out. Who knows? But again, you might appease some, you might lose some, but it seems like that rhetoric's also died down a little bit too. Now you've got mortgage backs being bought by a lot of the GSEs, so maybe. So of course Trump had to fire back, and that should not have been a surprise to anybody. He definitely decided he was going to respond in a traditional fashion. I think it's fine what I'm doing, Trump said, and we have a bad Fed person. I think he, meaning Jamie Dimon here, is wrong. Well, he also went on in that same interview. He said, I think that people that are paying 28% interest should be protected, Trump said. We're talking about for a 1-year period. Trump added that he did not think it was right for Jamie Dimon or anybody else to charge customers high interest rates on credit cards. Wow. So yeah, the boys are back and they're fighting. Now, I know we're seeing some grudge matches on social media, people fighting in boxing rings, but these two fighting, that's fun. I'd like to see that. So seriously meaningful exchanges back and forth. Dimon's remarks followed a video statement on Sunday from Jerome Powell, which we now know about. And of course, there's more to this story, as there are with all stories. Trump says Dimon wrong to criticize the DOJ probe. And I want to read a little bit more from this article. Trump said earlier Tuesday that he would press ahead with plans to announce Powell's replacement within the next few weeks, despite the backlash to the probe, which has drawn criticism from Republican lawmakers, including a threat by Senator Tom Tillis, a retiring North Carolina Republican and swing vote for the Senate Banking Committee. Tillis had said that he would block new nominations to the Fed until the matter is resolved. Trump also defended his proposal to cap credit card interest rates at 10% for a year, which will likely require congressional legislation. Banks have warned that the move could restrict access to credit and undermine popular rewards programs. And you are seeing banks down a little bit today on the day. So that's a good time for us to go here to one of my favorite new tools. That's our stock chart ticker right there. I got to load up here. So let's go look at the stocks. JP Morgan Chase, of course, I think is a worthwhile one here. Let's generate that chart. There we go. Nope, no, that's not it. Sorry about that. It is this bad boy. Where is it? Oh, what's going on? You know what? My stocks aren't coming up. I am so brokenhearted right now. This is not working when it's supposed to be working. Huh. There. Oh, nope. Still not there. Yet everything else is working. Man, that's a bummer. Let me see if I can refresh it and pull it up. Ah, there we go. Your boy got it working. See? All right, JP Morgan Chase on the day. Let's take a look at the day chart here. That would have broken my heart, all the work we put in this bad boy not to have that work. There you go. That's down on the day. Wells Fargo, let's take a look at them. See how they're looking. Also down on the day. You're seeing a recurring theme here. I think that's because a lot of these banks are getting hit pretty hard. Now, no, not to worry too much. They're doing pretty well year over year. This is the 1 year look at the chart here. So they're doing okay. They're still in the green, but certainly the narrative is in part pulling them down. I do think the banks are going to do well. That has been a sector that we've seen, frankly, a lot of people push towards, and a lot of people thinking that there's going to be a lot of M&A here. I think the community regional bank M&A activity is going to peak up. I think bank earnings are going to continue to be a shiny point part of 2026, even without further rate cuts. So this, to me, signals just a little bit of the narrative kicking in, because I think the market is basically saying vis-a-vis this response that this is the one thing they believe might actually happen, which would, in fact, eat into bank earnings. So let's go to the comments. How's Citi? I'll check Citi for you real quick. Let's check Citi. Citi, I think, is also down. Jane Fraser over there runs an interesting shop. I'm not the biggest fan of some of the things that she's done, but she seems to have done pretty well. This is the 1 day look at Citi coming up here. There you go, down on the day. So yeah, all the large banks, GSIBs seem to be a little bit down on the day. So that doesn't surprise me a whole lot. Let's go to the desk view. Let's talk to the comments section here for a little bit. I'm going to bring up the comments in the chat. And for those of you, no matter where you're at, it could look a little different because this pulls in from many different platforms. So let's see here. What do we got? Who's out there? Who's out there? Sean, always, dude. Sean, your commitment to helping us out, man, means a lot. Thank you. I appreciate that. They will expend less credit at that point. Yes, I think this is accurate. They will, in fact, expend less credit. If you're going to limit the amount they can charge, they're going to focus on two different things. Number one, they're going to put out less high-risk credit, and they're going to raise their minimum credit scores as a result so that they have less potential defaults in credit. We are going to talk about credit and credit defaults later on in the show. I think that's really an untested narrative that we need to get into. We have a whole housing section. Then we're going to talk a little bit about auto loans, a little bit about credit cards, and then a little bit about SACs towards the end. I think these are all indications that the market is willingly choosing to ignore because there's so many other positive things going on in the market right now. And I get it. Earnings are high, dividends low, but the indices and everybody else are popping off pretty high. Again, part of the reason why we also chose not to focus on the indices and come up with some proprietary algorithmic stuff, which bothers some people, but hey, I get it. Any other comments, questions, or concerns? Let's see here. Managing and juggling all this stuff on the back end from a tech perspective, it's a lot of work. I've got a whole new respect for how people in studios really have separate, segregated functions, because when you think about how much volume of information is being moved around at any given time, it's a lot. And something you probably wouldn't know unless you've been doing this on the back end at all. All right, so let's get into housing, shall we? I think the housing update is an important switch, and I think we should really talk about the real versus the narrative. And this is going to be a part where people get pissed off. But look, there's a lot of lies in the market, and I think the lies aren't intentional or malicious. I think the lies are because people have a tendency to want to believe their own people, right? You seek out confirmation bias, you buy into confirmation bias, you do your thing. So I'm going to do a couple different things here. I'm going to look at some of the data that came out today in the headlines. Then we're going to look at some of the stock related to these companies. And then we're going to talk about what's true and what's not true. Because I think there is a huge, clear, and palpable divide on social media. Then we're going to dive into social media and we're going to see some of that. You've got people on both sides of a clear housing aisle. People that are in the business typically or have some nexus to it, those who are not, who have some emotional tie to the opposite side of things. People are fighting like crazy, and this is really bad because we're not seeing solutions, we're just seeing anger. And until you see solutions to the housing market, I don't know how you solve for this rubric. Let's start off with the headline that was the most visible this morning that I saw, and that was, and I'm going to go to, I think, the social view for this here. There you go. Mortgage refinance demand surges 40% higher after Trump's post briefly tanks interest rates. Mortgage demand spiked markedly higher last week as the consumers returned from the holidays to find overall lower interest rates, and then a sharp rate drop on Friday on the news that from the White House. President Donald Trump posted on social media late Thursday that in an effort to lower mortgage rates, he would order mortgage giants Fannie Mae and Freddie Mac to buy $200 billion in mortgage-backed bonds. Just on that news, the average rate on the 30 years sunk briefly below 6% on Friday morning before bouncing slightly higher again, according to the Mortgage News Daily. Okay, so let's unpack, shall we? That does, on its face, sound amazing, right? You tend to go look at this and you go, oh my God, 40%? Wow. The market's booming again, right? It's booming. It's going to be huge. That's a headline that goes, okay, everything's healthy. It's going to return to normal. But that's not really true. And I think that's part of the problem that we're going to have to face here is that, yes, this happened. But you also had some things that I think are more important. Let's read the headline again. Mortgage refinance demand surges 40% higher after Trump post briefly tanks interest rates. But is that really solely the function? We just came out the holiday. People weren't refinancing during Christmas. They weren't refinancing during New Year's. You typically see growth in this time. Not to say that it's not, anomalous, but again, that's feeding into it, but we're not talking about that. We're not addressing it. The source here, Mortgage News Daily. I mean, they do have a vested interest in propping up the narrative. Not to say that they're doing that maliciously, but does smell a little convenient to support your people with big headlines like that call people out in a way that I think are frankly misleading, is probably the best way to put it. So I don't know that is not necessarily indicative of the housing market in and of itself. So what I'm going to show you is a counterpoint to this, right? Okay. And again, just to frame this right, something that I think is worthwhile to really speak on. If you have 40% of homeowners without a mortgage, and then you have the cohort that's left that has mortgage rates sub 5%, and a significant amount of them sub 4%, and almost 20% sub 3%. You start to go, okay, well, wait a minute. If mortgage rates fell to just below 6% on this news, what's the incentive for people to refinance? And again, this is mortgage refinance demand surging 40%. So the only reason that somebody would refinance in this set of circumstances, and again, this is not new purchases. This is not people buying homes because they need the money. This is refinancing of existing debt. Why would people be taking? Did they get a loan last year or two? There's not a whole lot of that relative to the rest of the cohort that's out there. So if you start looking at things from a 30,000 foot elevation, that news on its face just seems a little bit like it's spun. Could be true, but again, why? So let's look at a pretty interesting article I found on X here, which I think is one that, so I should reframe here and be very clear about what I tend to do with this stuff. This is, let's go to the social screen here. This is from X. John Brooks on X. Lennar is now selling their houses for less than 2018 prices net of incentives. Imagine being the person who bought in 2022. If you're that person, what do you do? I don't like that framing personally, because guess what? If you're the person who bought in 2022, you can still pay your mortgage. Your housing value going up or down is unrealized gains or losses. Nobody should care. If you're happy, you have the utility of your home. If you hold that home for several more years, you're going to be fine. So this short-term, near-term pain, okay? So let's not over-stigmatize it. But what he is addressing is still worthwhile to note. This is from Reventure, which is reposted by him. I want to give people credit when I found them, not necessarily just the source. So in this case, new home prices dropped by 27% for Lennar. That's just one of the home builders. Lennar's average selling price net of incentives on new orders from 2018 to 2025 source SEC filings. So somebody, i.e. Reventure, went in, looked at the SEC filings, and this is what we're seeing. Okay, so not necessarily booming. Sorry, Nathan, I see you over in the Instagram chat. It could be, but it could be booming for reasons that were unclear, which I don't mind people saying, look, the economy's booming, that's amazing, but let's be clear about why and how and things are going on. What up, friends? I'm going to put you in the chat here. Okay, so let's go back to this chart a little bit. So we covered this on previous shows, and it's important to note. So I'm going to go through here and clarify. Home builders have several different dials they can turn. Dial number one, you can lower the price. They don't want to do that because the optics are bad. It brings the average home price down. We are seeing the average home price just over 400,000 came out today drop. So that is happening irrespective of this. You could lower mortgage rates, but then that tends to drive home prices up. So you have this inflection point of lower rates. What can you do? Well, you can do what they're doing. You can play a little hide the sausage with the prices. And that's a simple thing to do, okay? All you got to do is say, okay, our price is X. Let's just say it's, in this case, up here, whatever our price is. And then you offer incentives, right, which bring the price down net to the client. But what you report to the street is that top number is, we sold a house for this much, and you ignore incentives. But if you go into the SEC filings, you see the real net price that's being sold, and that is what this article did, and this is what the chart shows. Somebody went in and said, okay, you said you sold for this, but you had incentives of this, which are bigger than you've given historically, and that net price, the sell price minus the incentives you give somebody to buy, and the price to you, the actual price you got, is going down pretty dramatically. Net home prices, net of incentives, down 27% from the peak here. 511,000 on the homes, down to now 375. 375 for a new home is less than the average home being sold. So if you look at the average home price right now, it's over 400,000. This is low. So basically, new homes are being sold on average for less than the average home price in the economy right now as of today's report. That's an interesting fact that nobody's really talking about. Anish in the chat here, capitalist for GMAC in a 5-year percentage with a 10-year yield. I don't know if that's a question or statement, but clarify a little bit more. I'll get to you on that one, okay? So let's get back here to the chart. So again, this provides a very different picture for what the home builders are doing. So let's go to the home builders for a little bit. And let's talk about them because I think that's probably worthwhile to note. Let's see, number one, what the home builders are actually feeling. And the best way to tell that as far as a proxy goes is public sentiment. And public sentiment is easily reflected by things like stock prices. So let's start with DR Horton, I think, DHI. Let's look at them over the course of one day. I'll generate that chart real quick. Maybe I won't. Come on, technology, work for daddy. It's loading, just loading very slowly, which is strange. Let's try Lennar. Maybe it's just a stock price here. There we go. Yeah, Lennar's loading. That's weird. Oh, Daddy's got glitches to work out on his side. All right, so Lennar on the day up incrementally. I would say that's probably not a big increase for the day. Lennar is the person we were just talking about in the article and their incentives. So again, not huge impacts there. Let's talk about Toll Brothers, perhaps. Let's take a look at their current status. There you go. Toll Brothers, ironically down on the day, but again, incrementally so. Not a huge meaningful drop. And we'll try DR Horton one more time, see if I can get them to come up here. There we are, DR Horton, again, incrementally up. So relatively uneventful day. I think part of the reason for that is that you got the average home price, which came up. Came down, which is still higher than this. So I guess you could interpret it as room to grow for them, but certainly not what I would call a fear-driven economy around the home prices and the home builders yet. So institutional buyers being banned from the market doesn't seem to have moved the needle here meaningfully. And then this news on the average home price coming out being down to 400,000, a slowdown of sales coming down is not moving the needle. I saw Ryan Serhant earlier on CNBC, and he was interesting in how he framed this. I don't necessarily know that I disagree with him in a lot of ways. You need extra supply in the market, but he's saying that things are booming, that market's good, and I would say he probably serves a very different populace than the average American. I think the wealthy neighborhoods and the wealthy demographic, which he largely serves, is the slowest to move. So I would interpret his opinion to be relative to who his clients and constituents are, and that is a super high net worth, ultra high net worth client. Well, I don't know that that's necessarily the same for the average homeowner across the country, the yous, the me's, right? So let's look at some subprime auto stuff. I think that's an important thing to think about here. And I'm going to take us back to our regular standard stream subtitles. Shout out to Saeed, who hopefully will join me one day, so I'm not jumping around, bouncing around with my hands in the air. But I think what's coming up next here is going to be a bit of a shock to most people because you heard everything we talked about today. And if you heard it, you go, okay, wait a minute, that seems like a pretty positive day, right? Like things seem pretty healthy, but I'm going to go to a full screen view here. There we go. This is from Bar Chart via X. Percentage of subprime auto loans that are 60 days or more overdue on their payment hit an all-time high of 6.65%. Well, wait a minute. Is that the reason that people are refinancing? Is this it? Here's the chart, prime versus subprime. It should be worthwhile to point out that prime, this blue bar down here, and I recognize if you're on the vertical streaming platform, i.e. Instagram, this is harder for you to see, but you can see at least the lines here pretty clearly. This goes from November of 1991 to October of 2025. And the prime demographic does not have the same ramifications. You saw a slight increase here, and increase here in credit card defaults for prime borrowers, but certainly subprime borrowers, those in the fringe, have a very much different reactive profile to the markets. And of course, the obvious low-hanging fruit in this chart is this trend. If we have hit the highest ever, what does that mean? Is that why we're seeing more refinance activity when the current average mortgage rate doesn't seem to match? Because that certainly could be the case. Let's see, capitalist square footage, acres, and price don't match. Yes, I agree with that. I think square footage, acreage, and price don't match on a lot of the home builder stuff. There's a lot of inconsistencies in the home builder reporting that are really difficult to verify and validate. We've called on the show more than once that this lagging indicator trend of housing in the macro economy is clearly a tool for smoke and mirrors. We have reached a point where you can get consistent, reliable data from the nationwide MLS, systems, for an example of this, right? It just doesn't behoove them to provide them to us when they can't control the narrative in real time. So it makes absolutely no sense that we can't get real time data that aligns with a lot of things like the home builder sales and the trajectory of things that are going on there. I understand if it's private sales or off MLS, there's got to be better ways in self reporting, but certainly. I think this is where blockchain technology really helps a lot of what we're seeing from a data perspective. Everything that would be on the blockchain would be visible. If it's visible, we can then get better data in real time as things record. For example, if you use the blockchain for recordation, that's a great example of how that could help solve that problem. Is that clear? Some of the statements you're making are kind of unilateral. I don't know really question marks, but that's my stance on that. So again, getting back to the subprime mortgage debt, you have again a problem here that's booming, and I think this is also goes in line with auto loans. You've seen the same thing here. Auto loans are 60 days or more overdue, and their payments hit all-time highs. So you're going to see the same thing with credit card debt, right? These are very similar trends. So, and I'm seeing this. I don't know how many of you guys are watching this, but this is probably worth a good sidebar here. I will admit that I fall victim to a lot of the narrative on social media and some of the toxicity. And you hate to say you like to see somebody else's downfall. I don't think I ever like to see anybody lose anything, but sometimes when some of these super hyper flashy influencers start to have the impacts of the real world and start to feel things materially different than they've been posting online, and the rhetoric that they're saying versus what they're actually living through are different, I think that's healthy. I think a lot of Americans need to see that these people who seem like these infallible social media influencers actually have some level of real financial implications to the decisions that they're making, and they're not dissimilar than the rest of us. And sometimes that high expensive lifestyle is in fact paycheck to paycheck, no matter how much money you make. So I think that's a good lesson for kids to learn. I hate to see anybody fail, but certainly I think that I've been drawn into a couple examples of that in recent weeks and months as the economy continues to turn. Let's talk a little bit about some of the stuff we saw from Capital One. AmEx shares sinking the other day. We saw this become a bit of a real problem, and it became very visible yesterday in the market. Let's go to the screen here. Here you have from Yahoo Finance. Capital One AmEx shares sink on Trump's credit card threat. Shares of Capital One Financial Corp, American Express & Co., and other U.S. banks sank after President Donald Trump called the credit card companies to cap interest rates 10% for a year, a move that could wipe out billions in profits for one of the banking industry's biggest businesses. This super high interest rate on credit cards. Capital One, the largest U.S. credit card issue, tumbled 6.4%. Again, this is yesterday in New York, and the biggest decline in 9 months after the president surprised the industry with a move he said could get into effect next week. Again, that would take congressional approval is my guess. I don't know that you could do it. I don't know the mechanism from a political standpoint that you could do that. Again, as an attorney, you think I would know, but I don't. I don't know how that would work. So American Express dropped 4.3%. JP Morgan Chase & Co., the number 2 card company, slid 1.4%. JP Morgan Chase because largely their revenues are from other places. So let's look at some of the credit card companies. I think that's probably a reasonable thing to do here, right? How are they performing today? Let's go back to the chart, and this is why it would have broken my heart if the stock chart didn't work today. I think this has been a good kind of sounding board. So let's see, is the market responding? Let's start with Visa. This is midday today on Visa. They are at 328.27, down pretty healthy, 4.35%. That's pretty big. Let's look at them on the 5-day chart and see how they've done over the last couple of days. Yesterday should be down as well. Yeah, there you go. So meaningfully down. So I think the credit card companies are in fact being impacted by this. That's a reasonable look. Let's look at MasterCard, MA. Here's MasterCard for you. Down 6.36% over the last 5 days. Just today alone. Let's generate that chart. Take a look at that one. Down 3.63%. So the market is basically telling you they think this is going to happen. they think that there is a real potential impact. Let's look at a couple more. Let's look at American Express, AXP. Big fan of them. Shout out to my American Express teams. Down 1.09%. I think that's because American Express typically caters to a higher average credit score than most of these other markets do. Look at them over the course of 5 days. Down 6.82%. So they're down meaningfully. So they took the biggest hit, looks like, yesterday as opposed to today. So they've had a little bit of recovery. And, well, of course, I would be remiss if I didn't talk about Capital One, who the article was about today. Keep in mind, down 6.4% yesterday. Today, down 0.39%. So they took their spanking yesterday. Let's take a look here. Yeah, yesterday, over the course of 5 days, down 9%. So the market has said you guys have had enough. Again, one of the things when you look at these charts, you see it all red. People go, "Oh my God, they're gonna have problems." Let's look at it from a wider perspective. Okay, here's a wider perspective. Well, they're up 27% year over year. So that's a pretty big increase. So they can take a healthy hit here and not bleed to death. If that's relatable. Speaking of which, though, I think there's been a topic that's been close to home for me. Those of you guys who know who that I have American Express cards. I use them, and one of the benefits you get with American Express is access to things like Saks. And I think it's a telltale moment of the times when you see things like I'm going to show you here. Go to the chart here. Go to the screen. Boom. Saks Global, the parent company behind the 159-year-old department store that's become both a destination and a symbol for luxury fashion, an overpriced one, and kind of ridiculously overpriced. Filed for bankruptcy protection after running out of cash and failing to find investors willing to finance its businesses. So the retailer filed for Chapter 11, which is a reorg, not a full bankruptcy. So to be clear, there is a possibility of them reorganizing, selling down assets, restructuring their debt, and continuing to operate. Of course, this was met with a whole lot of people going and rushing to the site because they have American Express points, and American Express is a partnership program with them. If you have the Centurion card, you get $250 a quarter to spend. Some of the other ones you get a little bit less, but you get quarterly a stipend to use, and they'll reimburse you on your AmEx. So if people flooded here to try to buy as much as they could before the market shut down, which I thought was interesting, and you could just see this human behavioral economics playing out in real time is really cool. Not to say that it's cool to see the downfall. Saks is overpriced, and it's an outdated model. I understand the personal concierge level service that people love and want to see, but I don't know that their stores really appeal to the masses anymore. And I know that ultra high net worth people are who they're catering to, but I can tell you that my wife and I never step in the store. We don't shop there. We'll go online and buy because we have that stipend. So they need to change their model. I don't know that their business model is still effective. I don't know that major box retailers like Nordstrom, who have also had their pain points as of late, have really adjusted to the modern day shopper. And I think the understanding of cheaper retail and cheaper fashion is starting to permeate. People understand that you can wear something like Rick Owens and pay a whole hell of a lot of money, but effectively that product has Chinese dupes or other dupes on places like Amazon where you have easily accessible too. And yeah, maybe the quality isn't as good and maybe it's not the designer, but it's a similar look. I think people are looking at that difference now and differentiating in a way they never did before. So it's certainly a very different time, and I think that between credit card companies getting hit, subprime auto being hit, this strange anomalous refinance when the economics don't seem to align, except for this sliver of people who had mortgage rates over 5 and let's call it 5.5%, that might make sense. But to me, it looks like people are refinancing to take care of their debt obligations because there are serious and real financial backstops here. And you combine all that with the fact that the IRS is now looking harder at things like side hustles, where people are now augmenting their lack of wage inflation over time with additional earnings. So it's going to be a strange market and strange things to come. Let's go to the chat. I've got a little more time, and I want to see who's still out there. I haven't checked YouTube. There we go. Regil, it comes from China. My man who bought fake insoles not too long ago. Yeah, that's right. And speaking of which, how are your insoles doing? Let's see. I am going to take a screenshot here, Anish, of your comments, which I think were helpful and insightful, and I'm going to put out a little more of an explanation. If I can do it without kind of giving away the whole proprietary elements of our model here. Let's go to Nathan on Instagram. In agreement, I helped job seekers land more roles. The 150 to 300K OTE crowd is getting crushed. Yeah, I think that's true. So this K-shaped economy that we're seeing is really starting to have an impact on, I think, the middle class. I think the middle class is getting crushed. And as a result of that, the middle class is kind of blending into what would have been the lower class historically. The nomenclature I'm just using as the historical nomenclature here, so no offense intended. And I think you are seeing that divergence start to be material. And I think that there is a stigma to talking openly about your financial position in the middle class, because let's say you're a doctor and some doctors are making $250,000 a year. Let's say you're falling behind. People go, "Ha, Billy, you're a doctor. You should be doing all the money in the world," but that doesn't necessarily jive anymore. And there's really interesting statements coming out now about whether you should even go to medical school or be. I'm an attorney by trade. I can tell you right now that AI can do a close job to attorneys now. You give it another year or two of being prepped with case law, which, and again, so this is an interesting example. So we think of data in the form of numbers, but data can also be case law, decisions, logic, and reasoning. And these learning language models, these reasoning models can and will get better at reasoning. And as over time, they are going to be able to be a better arbiter of law than an individual would. They'll be able to argue both sides without the emotional rhetoric. And one of the things I've seen personally is emotional rhetoric from attorneys year over year, time and time again, because they get too emotionally connected to advocating for their client. And I think it muckies the water in the legal system. And as AI gets better, you're going to find less and less value for those careers and less pay. People are going to be struggling more and more. Doctors, same thing. You're going to get to the point where AI can diagnose things better than we can as humans. And that's not like decades away. That's like a year or two away. I mean, we're there, frankly, right now. A lot of people are turning to it. What's interesting is this turning to AI for psychological dependence. People are speaking to AI as a person, which is really strange. And I find myself doing it in moments too, where I'm asking it quick questions on the go. In one way, that's what it's meant for. In another way, it's strange. So one last piece before we jump off the show today. We're going to cover a little bit of this on the podcast tonight, but I want to share with you a chart that I think is kind of cool to look at. We don't often share this type of view on the show, and this is kind of some of the things I'm looking at bringing to us on the show in different formats. And for those of you stuck around, this is my way of saying thank you for that. This is a chart of earnings week, which kicked off this week. We had Tuesday, today, Wednesday. You got Bank of America, Wells Fargo, Citigroup, United, H.B. Fuller, all of them reporting today. And for those of you who can't see, I'm talking about that section there. But the rest of the month, you can see all the reporting. And there's some really interesting reporting dates there that I think are really cool to see. Netflix is going to get hammered, is my guess. So I'm going to give you some high-level thoughts here. I think the banking sector is going to be relatively innocuous for now. You're going to see continued deteriorating trends. BlackRock, Goldman, Morgan Stanley, I think there's really nothing material here. PNC, State Street, again, these are all the banks and the financials. This is going to really tell us what's going to happen in the future with the financial sector in the upcoming weeks and months. Of course, you got the holiday here on Monday, and then you've got Netflix. Netflix will be an interesting day. A lot of the market's confused as to why Netflix is doing this acquisition, the Paramount Warner Brothers debacle. So that's going to be interesting to see how the market reacts there. I think on Tuesday you're going to hear a lot about that in the narrative. You've got Johnson & Johnson, Truist, Travelers, some insurance company stuff coming up in this week here. But certainly there's some big players. Whenever we talk about earnings on the show, we don't talk about everybody, obviously. We only talk about people that we think are meaningful coming up that might move the market. And this gives you a good view. And this is not even close to all of them. These are just some of the quote, heavier names in this space. So you will see a lot of this come up and will be talked about during our podcast and the weekly episodes if you listen there, or certainly if you watch the live shows here. So thank you all for tuning in. This has been an interesting show. I apologize for some of the technical challenges I'm still working through, trying to get 100% right. Some of this stuff is a learning curve in progress for me. I haven't done this before, and I'm trying my best to learn the physical side of things, the programming side, the development side, and obviously the modeling side from the analytics all at the same time. And it's been a bit of an overwhelming run at it. But thank you for tuning in. If you have any, thank you, Nathan, for watching. You watched the whole episode, man. That's really cool. I appreciate you doing that. And Sean, always a pleasure, brother. Thanks for tuning in. This live is meant for you guys, people who are really truly fans of the podcast. This is where the loyalty goes. If you think it's good, let me know. If you think it's bad, let me know. If you think there's room for improvement, also let me know. But I'm here to learn and grow with you guys, and hopefully we can provide something that's valuable. If this is valuable, I want to keep doing it. And if it's not, tell me I suck. Meanwhile, till next time, everybody.